Welcome to the ARMR Report, everybody. This is our morning meeting. Thanks for joining us. We do this every day at 8:30 for ARMR Insiders, sharing it this week with all of you. So the object here is to get our heads straight for how we're going to be trading or investing in the market today. So I'm just going to go over real quick with you some trades from yesterday and how we are approaching today from a trading standpoint when it comes to the indexes. And then some thoughts on the risk monitor. You know, the ARMR investing way is how I run my own personal capital. And it's a process where we follow 3 simple steps. We build our whiteboard. That's where we do all of our fundamental research. And we're going to go over a list of a handful of stocks right now that are at the top of the whiteboard, the top shelf of the whiteboard. So I'm going to share with you some of those names. Those are the names we may be adding to portfolios in the near future. Then what we do is we use algorithms to tell us when to put capital at risk and when to protect capital. The top 7 indexes are used: NASDAQ, the S&P, the Dow, the small cap, the IBD 50, which is our innovator lists, and then the momentum and the value indexes. Those 7 drive our risk decisions, okay? And what we look for is confluence across the 7. When we see a footprint of behavior on all 7 of the indexes, every now and then it's 5 out of 7. There could be a couple that are off kilter, but really the vast majority are all moving in one direction. That generally will give us a green risk monitor signal, and that's the signal for us to put capital to work. The idea here is that these algorithms are helping us uncover flows of institutional capital into and out of the market. When the elephants are running, we want to be ahead of that stampede. So confluence is a big part of that. And institutions don't buy one stock here or one stock there. They make risk on, risk off decisions, and they put capital to work aggressively or take it out. And so it helps us to follow that. So we use those algorithms for the big picture view, and we call that the risk monitor. Then we use single stock algorithms to help us determine which names on the whiteboard we want to buy today or tomorrow. Because there's a lot of names on the whiteboard. I love them all. But just because I love them doesn't mean I should own them, right? So we need a guide to help us say, okay, this is the best setup for us to put capital to work where the probabilities are at their highest that the asset's going to go up and the reward is worth the risk. That's what we're looking for. Those names elevate to the top shelf of that list. I'm going to show you in a minute a handful of names that fit that parameter. So before I delve in, don't forget, this is what I do personally. So guys, you got to do your own due diligence, your own homework. Obviously, your risk tolerance is different than mine. So what I share with you is a guide for how I manage capital, my own, and for investors I run money for. But over time, I hope that I can share with you successes and failures, right, to help you become a better steward of your own capital. That's the point here, okay? So let's dive right into our trading posture, and I want to share with you really the morning mantra, I like to call it, all right? I try to do this every morning. The hardest part about day trading is getting your mind right every day at the same way, because things happen in your personal life, things happen the day before in trading. Maybe you were out late last night having too much fun and you're tired, and it can be hard to get your mind into that space where you've got to be in order to trade successfully. And that space to me is simply we trade what we see. We don't have any bias. We don't have any ego. We don't have any memory. We just trade what we see. There are a million reasons why not to take a trade. Every single trade. Some of the greatest trades I've ever made. I could list for you, I could unroll a scroll that's 5,000 years old of reasons why I shouldn't put the trade on, right? And it would have stopped me from making a lot of money that day. You think you get my point? Simplify, simplify, simplify. You have a strategy, you execute it. You see an entry point, you put a trade on. That's it. And shut out the rest of the noise. It's hard to do. It's hard to do But I wanted to share with you what we did yesterday because it's an illustration of how, unless you can get your mind into this space, you just can't make money trading. Okay. So what we did yesterday is very, very difficult thing to do for most day traders. And that is that we were short in the morning, took a quick loss, and immediately got long to have a very profitable trading day. I advise, I'm going to stop you right here before going forward. This is like a level 10 hike, okay? If you don't have the right shoes on and you're out of shape, you don't want to go do this. Most people should not short. It's hard enough getting the long side right. You start shorting and it screws with your head, you're going to miss great long trades. So if you're new to day trading, if you're just starting out, even if you've been doing it for a long time and you're making money on the long side, there's no reason to start shorting, okay? I short infrequently. Every now and then a setup occurs that is a short setup for me, and I'll put a trade on. A couple things to remember before I show you this trade. Number one, whenever I short, it's a smaller position size than my longs, usually about a third the size. Okay, so whatever I'm going to put out long, I'll put a third out when I go short. Simple reason. Statistics are against us when we short. The market goes up most of the time. Something like 80% of the time, the market's going up. So whenever you put a short out, you're already behind the eight ball. You're already expecting to lose money from a statistical standpoint. All right. So smaller position size. The other reason is I really don't want the short to get in the way of my ability to make money long, because that's where the real money's at. So you say to me, well, why put a short on at all? Well, that's because the payoff on the short can be enormous. You put the short on at the right time, the market literally implodes. Like, you know how markets go down faster than they go up. So the payoff, the reward is worth the risk. We just have to manage the risk correctly with position sizes, and understand that we don't want to be out there shorting every day, right? There has to be specific setups. So anyway, this is day trading, not 101. This is like a 401 course, because to go short and then go long is not easy, and it can really mess with your head. So caution. So let's jump into a quick review of yesterday's trading. We were long both the S&P and the NASDAQ. So these are 3-minute charts. Every bar is 3 minutes. Okay. Where the purple lines are the spot gamma locations. The black dot is our volume weighted average price, the VWAP, standard deviations above and below, opening ranges with Fibonacci's above and below, and average true ranges above and below. All of those lines are automatically drawn using the ARMR price movement profiler, which takes basic off-the-shelf calculations and then infuses volatility components on top of them. So when I say ARMR VWAP, it's not necessarily going to be the exact same VWAP you're using, because it's going to include top day and multi-day volatility to change it a little bit. Okay. So let's just look at this trade. And I'm, of course, as you guys know, I'm out there building for you the ARMR Playbook. So I'm going to be, just like I did right here, 1, 2, 3, 4, and 5. When you go to the website, you can go click on, and this is just a quick reminder here. Whoops, that's not what I wanted. Just so you guys can find this. So right now we're in the captain's log, but when you go to the ARMR Insider part of the website, you get your 4 basic tiles that tell you our stance, risk monitor, portfolios, and you click on that. You can see what stocks we own, the prices we bought them, what our targets are, what our stops are, the whiteboard, and of course, exclusive videos. But right here, I've added this ARMR chart diagrams. You can click down there and you'll start to see, what the process is step by step. If it's a Fed day and we get this set up, this is how we trade. It's the playbook. Okay. So this is going to go in our playbook today. And I'll put it, of course, first into the Slack room for all you guys to see, and then I'll add it later. But basically, here's the trading session yesterday. You know what? I have to show you first, because there's no short there on the S&P. The first short trade, I don't ever short the S&P. I always, if I short the small caps and the NASDAQ 100. I only go long the S&P. So what we had yesterday, this is the NASDAQ, okay? We had a relatively flat open that rallied right off the open, put in a pivot top, and had an aggressive bar down below the VWAP. That's where I put the short out, the bar that goes below the VWAP. Bang, okay? Because there are many, many mornings, and I could show you through the playbook, where you get this setup with a reversal like that implodes. Maybe it goes down and closes the VWAP gap, would have been the target on that day, all right? And so we would have had a quick opportunity to make some money short, and then we would have looked for long. So I'm always going to put that short out if I see it, particularly after a couple of big rally days. So the market had a big reversal day, then a huge up day the day before, and then it pops higher in the morning and immediately reverses. That often leads to selling, so the probabilities are high. That's worth a trade, and the selling's usually aggressive, so the reward's worth it. So I'm going to put a short out, okay? Within 9 minutes, wait, this is 3, 6, 9. Within 12 minutes, okay, the NASDAQ reversed that short signal. So it's incredibly hard to do. And this is why the mantra is trade what you see, no ego. Okay? No ego. Because it's very hard if you have an ego to swap from short to long. And if you have a problem with that and you just can't short, just stay away. Let the market crater. You're in cash. Great. Build an alpha. Look for your long trades. But if you can master that ego and get rid of it, then you can short. You put your trade on, and if it reverses in anywhere between really 3 and 6, 3 to 9 minutes is the best. 12 minutes is fine. But the minute when it reverses like that, it's almost confirmation that it's a long day. So instead of being disappointed that I've lost a little bit of money, I don't care. I mean, I put a trade on. Sometimes I'm going to lose money. I don't care about that. You have to get in that headspace, right? This is not, no system is 100% accurate. So there's going to be some losses. That's fine. The faster we take them, the better. A setup like this shows you that the market now is about to go through the roof. Breakdown, reverse. That's where you put the long trade on. And that's exactly what we did. And you can see these yellow bars as our targets and our stops. So when we get up here, we book a profit. We're looking for up here, which is the next target. We book some profit. We raise our stop here, and we get stopped out right in here. Market ends up going lower, puts a double bottom in at the VWAP, and then closes higher at the end of the day. You could put a follow-on trade in here, okay? You could put actually money back to work. After you've booked this profit, you can go put more money to work right here on that reversal, okay? So looking at the S&P now, and this is kind of interesting. While we were putting a short out on the NASDAQ, you could see the S&P did not break down, which could have stopped you from shorting, quite frankly, because you would have liked to have seen the S&P confirm the NASDAQ trade, and it never did, okay? And so what the S&P does is it opens flat, trades at the opening range high, and makes a pennant. And this green box is the buy bar. So we got long the S&P, and of course we buy the triples on the S&P. So SPXL is what we're buying to make money on our day trades here. So when this pops out right here, it's a pennant that breaks above the opening range high and the ARMR moving average, which is a key location for us. This kind of orange and gray line here, very important. When it pops up right there, that's our long position. The low of that bar is the stop. Please notice that we never go below the low. We don't even challenge the low of the trigger bar. The best trades never challenge the stop. So you have your largest position on, boom, right here. It runs up to the first location where we book a profit. We look for it to hit the next target, and it never does. 1, 2, 3, 4. It puts in 5 pivot tops. Okay? And so when we were actually exiting the NASDAQ, we exited this position right around here. It popped up for a few bars, and then it sold off, right? So that's the trade. We also were trading small caps at the same time. I don't always trade small caps from the long side, but couldn't avoid this trade. So we had that short out, as you can see on this big down bar right here. It never went lower, okay? Actually, the short we put on right here had the big down bar consolidated. That yellow bar is where we got short. It never broke below the opening range low. And when it popped out here, that was your entry point. we were actually getting long right here. I should have been getting long right here. That was the entry point. I waited a little bit, took my position as it took out the opening range high, and it went right up to our target. And you can see it actually stopped at our target. Okay, so those were the day trades yesterday. We'll be looking to trade again today, long or short. Holiday shortened days, not shortened, but I mean, tomorrow the market's closed, so there's not going to be a lot of volume, but we could put some good trades on because options are kind of driving the decision making. So if volatility continues to go lower, probably it's a long day and there'll be some trades we can make. So we'll see. It's also possible the market just goes into a tight range here and dies the rest of the day. So we don't want to over trade today. That would be my biggest concern. But the mantra is trade what we see. No ego. All right. Now let's talk about investing real quick, and I'll get to your questions, and then I got to get out of here. Let's get to a quick review of the risk monitor. Let me talk to you real quick. So the risk monitor is still red, and there was some debate yesterday afternoon before the close. I was sharing information with ARMR Insiders on the desk. It's possible that the risk monitor will turn green. And I was going to do an in-game update, but then when I got to 3 o'clock, I realized it's not going to turn green. So there's nothing for us to talk about. The risk monitor, guys, is not trying to catch. It's not designed to catch every wiggle higher in the market. If it was, I think it would be, quite frankly, worthless. So the first thing you have to understand is there will be times the market goes up and the risk monitor is red. The risk monitor is not about catching little wiggles higher because we're in a holiday season or the end of the year and maybe 6 or 7 stocks carry the entire S&P and NASDAQ higher. That's not a reason. That's not what the ARMR report is about, and it's not what the risk monitor is about. We're trying to identify flows of institutional capital. We're trying to get on the right side of probabilities when reward's worth risk. We're trying to identify the start of moves that can last not a couple of days or a week or two, but months. We want to try to get in there and have a real nice move where we can make investments and have a high probability that those investments over time can make us money. So it's not a short-term oscillator. We look at confluence. There's no confluence right now in the market. So we're at a really strange crossroads. The two most important indexes that have been driving the market all year, the NASDAQ and the S&P, are telling us their own little mini risk monitor, or what should I call it? The algorithm for those indexes is green, right? So you got a green in algo on the S&P and a green on the NASDAQ. Okay, so the prospect for the indexes to go higher, and those are the most important, is telling us market's going higher. To add to that, the small cap index joined the fray and went positive as well. So 3 out of the 4 majors went positive. The Dow is still telling us no go. The utter destruction that's gone on in the momentum stocks and the leading growth stocks is not something that can be corrected overnight. I know since 2020, and a lot of you are new to investing, that you believe every single dip has to be bought and V-shaped reversals are normal. But if you're a student of the market, that's not true. That's only true in a period where the Fed is adding massive amounts of liquidity and buying corporate debt. We're not in that period anymore. The Fed's reducing liquidity and they're threatening to raise rates. So what we have is mass destruction in leading growth stocks and momentum companies. But about 6 or 7 major stocks are levitating into the end of the year. Not a surprise. They've done well all year, and institutions are going to support their favorite names to have a good end of the year. So those names are going to levitate. But the ARMR report, and particularly risk monitor, is designed to uncover significant flows of capital, not just end of year manipulations of 6 or 7 stocks. I'm talking about the Netflix, the Microsofts, the Apples, the Teslas, those types of names, right? Those are the names that are driving the market. NVIDIA. Just look at the market, look at the S&P and the NASDAQ, the weighted indexes, and see what's happening, right? So those 2 indexes are telling you, hey, market can go higher. But other major parts of the ARMR report, or the risk monitor, is telling us there's no opportunity here. So we're really at a crossroads. Do we just follow the 2 big indexes and throw money at the market? We could do that. But then I look at the week that we're in, and volume has fallen off of a cliff, as it will going into a holiday shortened week. So you get algorithms for the NASDAQ and the S&P that tell us market can go up from here, even though volume's fallen off a cliff. So it's clearly not institutional buying. What we have right now is a market trading from the put wall to the call wall inside of a range. That's just not enough to change the risk monitor. Now, I can see next week when volume will come back. It's a full week at the end of the year. Volume will come back. And if we get confirmation from other parts of the risk monitor, I could see a shift from red to yellow. Okay? I could even see it if you wanted to do it today. I get it. I wouldn't do it right in front of the holiday weekend, but I get it. And if that shift occurs to yellow, which I've never really considered before, to me, it's always red or green, right? And then yellow's after green. But could you go from red to yellow? It's possible. What would that mean to me? It means that I might buy some of my favorite investments off of the whiteboard where individual stock algos, the ARMR algos, are telling us the entry points right. And so I'll try a couple of investments on my favorite names. I will not be putting index swing trades on with the risk monitor yellow. It's just not right. The index swing trading part of my portfolio will only be put to work when we go green, when we have confluence. Otherwise, I'll be day trading the indexes. I can make more than enough money day trading the indexes. I don't want the swing exposure of the indexes. But would I want to try to own some of my favorite names that have the right setups with an algo entry point? And if we start making money there, that might segue into a future risk monitor green. We'll already have made some money in that part of our portfolio. It's possible. I might take 30% of my capital and own those names. So let's go look at a couple of those names. So I'm not saying I'm doing that today. I'm not doing anything in front of a 3-day weekend. Next week, we'll come back. We'll see if some volume comes in that drives the market higher, that turns the Dow positive. Who knows, right? And so now we have all 4 of the big 4 telling us it's time to get long. Maybe we'll put some money to work. And I'll probably do it in some individual names. So here are the names that I'm looking at. First of all, semiconductors. If I did an ETF, that's the leading ETF. So I'd be going there. And of course, the 2 top names in that space that are on the top of the whiteboard, you're going to see AMD, right? We already traded this from here to here. We booked our profits. It's back to the 50-day. It's making a nice tight pattern at the 50. That would be an entry point. So I could see owning AMD, and I can understand owning NVIDIA. Also, these are 2 of the names that are driving the S&P and the NASDAQ. So if we're going to have a nice, strong close to the year in the 2 biggest indexes, chances are these 2 stocks are going to go out near the highs of the year. So I can see putting those positions on. Doing some work on MDB. Love this story. Did some work on it down here. Missed that cup and handle breakout. Didn't own it. doing more work on it. You guys can find that under the research section of the website. Okay, whenever we do research on a company, and either we're talking to management or we're listening to conference calls, or we're part of participating in conference calls, we do that right here. ARMR Fundamental Research. You can click on it and find out what we've uncovered, what information we think is valuable that will help us make money going forward. So there's the algo entry point. It was actually right in here then on the 21st. All right. So there's a name. Snow is another name at the top of our list. It's carving out a double bottom. I don't like how wide and loose this is, but it does look real good here back above the 50. This is a perfect cup and handle on a, since the stock came public. Trade Desk is probably the number one name on my list. The chart pattern's perfect, and the growth story is just phenomenal. So these are some of the names that I'm looking at that may make it into my portfolio next week. Datadog. Just took care of that conference call yesterday. I'm not, Fortinet, I don't know what I'm going to do with Fortinet, but that chart looks real good. And it's on my list. A couple of semiconductor companies also. I think Microchip is just a perfect setup. We owned it here. The risk monitor went red. We got out of it. But look how the stock is holding up perfectly at the 50-day. That's a perfect setup on a semiconductor stock. And then, of course, we had this great earnings announcement out of Micron. So we're on the 4-day watch here on Micron. When something gaps up, I wait to buy it 4 days after the gap. So gap up, yesterday's day 1. We need 2 more days, preferably down days, day 2 and day 3. And then you look to buy day 4 as it breaks out. And it takes 4 days to prove it's not going to close the gap. If it's going to close the gap, usually it breaks down within 3 days and goes down and closes the gap. So if it doesn't do that, I might look to own Micron there. And to round it out, I'm just going to add shares of Nokia. There's been a lot of talk about Nokia. I was on the conference call the other day. It's not the sexiest story to me, but it's definitely a turnaround story that's riding the 5G wave with a chart pattern that's perfect and a ARMR algo, single stock algo, giving us an entry point. So I could see Nokia. All right. So those are my thoughts right now. It's already 9:15. I got to go start the live trading desk for ARMR Insiders. But if there's any quick question, I'll certainly answer it. Oh, I love it. I love it. I hope so. I'm trying to offer you real information that can actually make you money instead of running around like a chicken with his head cut off. All right. Any other questions? PFE you want to see? A little chart porn for you, Chad. Chad's looking for chart porn. There it is. Thank you so much, Chad, and God bless you and your family as well, my friend. Let's all give Chad a round of applause for catching this trade over the last couple of days on Society Pass. Boy, you've just crushed it right there, right? Well done. Cannabis. Do I have an interest in owning cannabis yet? So that's a great question, Saber. And let's just look at MSOS as a guide. There's just nothing in that chart pattern yet that would get me long MSOS. You want to bottom fish it. I get it. I can see the bottom fish idea. But let's be honest, I've tried a couple of bottom fishing ideas, and all I did was hook up on some bottom structure and lose my terminal tackle. All right. For those of you who are fishermen, you know what I'm talking about. All right. So, I mean, I love cannabis. I want to own cannabis, but look at the names that I showed you. The NVIDIAs, the AMDs, the trade desks. These are stocks that have the right chart patterns that go with explosive growth stories. MSOS is not a chart with the right pattern, not even close. It can't even make higher lows. It consistently makes lower lows and lower highs. That's something locked in a downtrend. And there's no legislation in sight. There's nothing going to happen between now and the end of the year. Okay. No, we're not going to wake up one morning in the Christmas stocking, as senators agreed on the SAFE Act. I mean, so there's just, the landscape is not changing. 2022, I think, can be a big year for cannabis because it recovers, I think. But until we start to see higher highs and higher lows, we're just literally investing because we love an idea, and that's not a way to make money. Jim, I don't know that stock, brother, so I can't help you on that one. I don't know if you're asking me about NGO. No, I don't get a symbol there, or VUM. That doesn't work for me. I can't help you out on that one. Okay. All right, guys, listen, I, as always, appreciate your time with me. Oh, there's a quick conversation I wanted to have. I know I got to get out of here to start the live trading desk, but a discussion about silver and gold and which one goes up and which one doesn't, which one goes up first. There are many different opinions on that. Okay. So I know I was reading something in the ARMR Slack trading desk that some guy on the internet thinks that silver goes down the first half of the year as gold goes up. I respectfully disagree with that opinion, but I mean, everyone's got an opinion on this. Okay. But I totally disagree with it. And the whole philosophy that silver will go down because the economy is going to slow down. I mean, this is what you were highlighting. You were saying that silver is going to go down. Not you, but this guy is saying silver is going to go down because the economy is going to slow down and there'll be less demand for silver. That was the argument that I was reading. Okay. And I don't mean to be rude or anything, but that's just ridiculous. Okay. If silver was 50 right now because of economic improvement in the last 12 months, and you wanted to tell me that the economy is going to slow down, so the inflated price of silver would go down, maybe there's an argument. But silver is ridiculously cheap and hasn't had any type of, and this is my point. If silver really went up and down based on economic activity and shortages, silver would be trading at ridiculously higher prices right now, okay, which did not happen. So then to assume silver will go down next year because the economy slows down, I mean, that argument just doesn't make any sense at all, right? Silver and gold march to the beat of their own drum and make fools out of most of us most of the time when we start trying to come up with grand analysis of why these assets move. So I put all of that in the trash bin. I mean, that goes right into the circular file, all of those comments. And I just trade what I see. That's a double bottom in silver. I'm putting a trade on. We'll see what happens. That's my point there. Okay. I think that will save you as opposed to listening to somebody expostulating on why silver will go down because the economy slows down. I mean, are you with me on that? We could talk more about that in the Slack room. Now I've got to go. I appreciate your time with me, everybody. Have a great trading day out there and stay nimble. Stay nimble. When I say, what does that mean? Stay nimble. It means if you're short and you get stopped out, you go long. You stay nimble. All right? Get that ego out of the way. Have a great trading day, everybody.